You are listening to the Wealth Formula Podcast with Buck Joffrey. Get ready to change your life.
Welcome, everybody. This is Buck Joffrey with the Wealth Formula Podcast, coming to you from Santa Barbara, California. And before we get started, I want to remind you that there is a website. This website is called wealthformula.com. It is where this podcast lives, and there's lots of resources for you there to download for free books and stuff like that, webinars, etc. Go check it out. Also, want to mention that if you have not, you should consider, if you qualify, of course, joining the Investor Club. The Investor Club is for our accredited investors, and if you want to take this information, the kinds of things that we do, and actually get off the sidelines and join, that's where the magic happens. That's where we do, some of the deals and things that make sense for us, whether it's real estate or other alternative assets. We've got a ton of stuff coming up in the next 3 months, and I want to make sure if you have not done so, you onboard if you are accredited. Now, what does it mean to be accredited? You don't have to apply for anything or get any certification. What you have to do is just be who you are, and if you happen to be accredited, then you are. So if you make $300,000 per year as a joint filing couple, at least for 2 years, or $200,000 if it's just you, or you have a net worth of $1 million outside of your personal residence, then you are considered accredited. There's also ways to do it now, which again, you'll have to look up. There's new ways to do it where basically if you maybe don't have the financial criteria, but if you have various types of certifications that make the SEC believe that you are smart enough to invest for yourself, then you are also now accredited. Anyway, check it out, and if you qualify, just sign up for the crew, the club, and lots of cool stuff coming down the pipeline here in the last 2 or 3 months of the year. Now, as far as the rest of this year, well, listen, we are just a few weeks away from a presidential election, a crazy one at that. It will be, I guarantee. Here's what's going to happen, in my opinion. You are going to have an election that potentially on election day will have a different, leader than might actually win the election. It is going to be crazy. I think it's going to be the craziest thing that we've seen since the year, the Bush v. Gore years. And I think it's going to get ugly. And we have to pay attention to that. People who've got their money invested in, the highly volatile markets. If I was in the stock market with a significant amount of sum of money, I would seriously be thinking about doing something to hedge over the next month or two, as we have October surprises. We have elections, and we have all sorts of craziness happening. Ongoing fallout from COVID-19. Decreases potentially in government support, and who knows what else. Now, if you have been an accredited investor who has been participating in our investor club, fortunately for you, you have been pretty well shielded from having to worry much. Fortunately, as it turns out, I have been, as the leader of this equity group, preparing for a down cycle for a few years. And in that regard, I've been really focusing on working class apartment buildings, self-storage facilities, and other uncorrelated assets. Not that real estate is definitely correlated, but some other uncorrelated stuff, which we will continue to talk about within Investor Club. And, having those focuses specifically in the last couple of years turned out to be the right move. Of course, we didn't predict COVID, but we did predict that there would be some reset of the longest expansion in GDP, American GDP history, which, I'll tell you what, it doesn't take a brain surgeon to figure out. Of course, I used to be a neurosurgery resident, so I can say that. Now, many of our properties in our group, our Investor Club properties, are continuing to perform very well. As well as pre-COVID levels, and in some cases even better. You're seeing some of those things that we are doing. Some of you are seeing reports of our Dallas properties right now, where we're every month seem to be doing better and better and better. So it's pretty incredible. And in reality, I will say that in our market specifically, working class, high growth markets like Dallas and Phoenix and all these areas, there really isn't a lot of distress. It's not like we just happen to be the ones who are doing well. As it turns out, there's not a lot of distress in these areas because that's actually doing pretty well. Now, if you were in multifamily in California and there was rent strikes, you might have other issues. If you were in A-class apartments, you might have other issues. But listen, we are doing, I couldn't ask for more in terms of how we're doing. I'm very happy with it. And frankly, it is my opinion that if we get through the next 4, 5, 6 months relatively unscathed, we may see an even more expensive market than before as, the big money starts to see our space as a potential safe haven. So that could be really good for us as we continue the rest of this year and we continue to accumulate property while others appear to be afraid to do so. So anyway, I'm hopeful that is indeed what happens in our niche. However, it is highly unlikely that many of the other real estate subclasses will do well. Specifically, you look at the single-family homes in middle-class markets, they're seeing distress. You're going to see the end of mortgage mitigation efforts. They're going to expire, and you're going to have a lot of problems there. You got non-residential commercial real estate such as office and retail. Well, man, those are like toast, right? Big trouble as our government assistance expires, distress begins pushing prices downward, etc. And in that regard, we could see some great buying opportunities as well. And so for our investor club, we're going to, keep our opportunities open to us. We're going to move where the opportunities are. We're going to move to where the puck's going. And that's what's going to make us continue, hopefully, to be as successful as we have been. And, these kinds of distress situations are where opportunities created. The whole real estate market really is in flux, and we need to continue watching it closely. So while it may not seem on the surface, listen, I live in Montecito, California, which is unincorporated Santa Barbara, and our prices are off the charts. These crazy, everybody's from LA and San Francisco is moving in here, and you got Prince Harry and Meghan Markle moving in, and everybody's is driving up prices. There's no inventory, and you're seeing that in some markets, and in some markets you're just getting hammered. And it's mostly the places that are not really expensive and fancy that are getting hammered. And guys like George Newberry are in the note business are seeing this firsthand. He's seeing default rates as high as they've been in 8 or 9 years. Anyway, I think it's always a good idea to talk to a guy like George, and that's what we're going to do today as we speak with him once again. This is, George has been on the show as many times as anybody else has, more than anybody else, I should say. It's always a great conversation, and that's what you're going to get after these messages. Welcome back to the show, everyone. Today, my guest on Wealth Formula podcast, well, he's making his 150th appearance on the show. No, I'm just kidding, but he's been on a lot. He's a good friend of mine and the show, Mr. George Newberry, who you probably know through one of any number of businesses that he has and has started and that we've participated in one way or another as a community. There was initially American Homeowner Preservation, which later on became AHP Servicing, which deals with non-performing debt. And there's a fund there, which we'll talk about a little bit more today. There was also pre-REO, which we've been talking about a little bit on this show as well. It's a good opportunity for people looking to get their hands a little bit dirtier and potentially, kind of rack up a few real estate professional hours at the same time. And so that's been great too. But in the meantime, and then wait, where there's also debt cleanse, right? We talk about debt cleanse. Forgot about that one, George. You're still rocking and rolling, man. Welcome back to the show.
I appreciate that, Buck. And actually, it's 151st appearance.
Yeah. The funny thing, the funny thing about you is, you've got all these businesses, and I feel like, I think you're actually like 5 or 6 years older than me. I think you're like 51 or something, right? Something
54.
Like that. 54. Okay. Well, you only look 5 or 6 years younger than me, or
appreciate
older
that.
than me. You look younger than me. But I feel like I used to have the energy to start businesses like this, but as soon as I hit like 44, it kind of just died. And I don't know what what kind of supplements you're taking, but I think I need some of that. George, so today we're going to talk a little bit. I wanted to get your feedback again. People are very, very curious what's going on, in the housing space, and because you deal with notes, with mortgages, etc. I'm curious, what is the latest? Are you seeing anything different from, a couple months ago when you were last on in terms of, increases in distress, or, what's happening around the country?
Sure. Significant increases in distressed mortgages and just economic distress in general in our country. That's apparent from the headlines. And, there's been measures put in place, forbearances, stimulus, and whatnot, that have tried to kind of delay this with the hope that, after 2 weeks was the original, but after a few months, everything gets back to normal. And I think it's increasingly apparent that things aren't getting back to normal anytime soon, and that there will be some significant economic pain in this country, which is unfortunate, but it's what we have. And so for a company like AHP, that does mean that there's an increased supply of distressed mortgages at attractive prices. We're already seeing that, and we anticipate the fourth quarter and next year that will only increase significantly. And that means opportunities to both help families that are struggling by buying these at a discount and sharing those discounts with them, and also to earn a good return for our investors.
Let me ask you this. So try to give us some perspective and some flavor on that, because you started AHP or as American Homeowner Preservation, right around the last major economic crisis, and obviously as time went on over the next decade or so, things really, really, really tightened up. And now it sounds like what you're saying is, okay, well, things are loosening up. There's more inventory. Can you give us a sense, sort of at a quantitative level, like what that's looking like?
Sure. So you're right. We started buying mortgages a decade ago, and the supply at that point, and that was about 2 years after the crisis really got going. There was a massive supply of distressed mortgages, and we were a tiny company that was working with a very limited amount of money, and we were able to right away go and buy from the biggest banks in the country. Citibank was selling to us within a few weeks of us getting started, and then as the economy improved and the pricing on distressed mortgages became more competitive and the supply became dwindled, that wasn't so easy to buy as attractively as we were. And go back a year ago, it was very difficult. AHP had a lot of money in the bank and very few favorable opportunities to deploy that money. That's all changed in the last 6 months. Right away, there wasn't an immediate change, but June, July, August, we've seen a lot of opportunities to purchase. I think that's just the beginning. We're trying to be. Do
you feel like diligent. It's like back at maybe like 2012 levels or 2014 levels, or is it still not like that?
For distressed mortgages, yeah, I'd probably call it 2012 and going backwards. So we're going to be probably at 2010 levels in 6 months.
So tell me how that's working, because obviously. There was, it's interesting because I think, I kept hearing about banks and mortgages that the big ones, at least like Chase and Wells Fargo and stuff, they were allowing mortgages to be essentially, it wasn't like they weren't tacking on the payments to the end of the loan. They would, they would forgive and say they wouldn't report late payments for 3 months or so, but at the end of that 3 months, they expected you to pay all of it back. Is that sort of what happened here?
Yes, that's very much what's happened, and but now it's been extended, and so that forbearance period has been extended, but not forgiven. And some instances they're putting them, go 3 months and then they're all due, or then they're paid back over 3 or 6 months, or in some of the government-backed loans, it's put onto the very end of the loan, and so there's different iterations of the same goal, which is to take those payments, which would be now, move them to some point in the future, and give the borrowers some extra time to get through this challenging period.
Yeah, I mean, if they move them to the back, I mean, I feel like people have a better shot. But I mean, you got these people who, like these major banks that are expecting a payment, to get caught up, and the economy has not substantially, improved, and talk a little bit about what the government's input on this has resulted in, and what we can expect to see in the next couple months.
Well, the challenge with some of the government programs is some of the everybody hears on the news, hey, there's a big forbearance program, or there's ban on evictions, but it for the forbearances, it only applies to government-backed loans. Generally, is where it's you have to do it. With privately held loans, you can voluntarily offer forbearances, and we've done that. I think most servicers have done that, just because you recognize that otherwise, a lot of people just are unable to pay. And but I think what's the unknown and the challenge is how long this is going to go for, because to have this go for another year on top of the 6 months that it's already passed creates a lot of somebody's taking a hit here, and it can't be the mortgage holder, the servicer, the homeowner, and the government. Those are the players, and who's going to ultimately pay for us? And that's an unknown question at this point.
Yeah. What's interesting too is, I come from the apartment space, and we're trying to kind of see how that plays out as well. But so far, there is very, very little distress in the multifamily market, across the country. And as a asset manager myself on a lot of these, I look at it and I think, well, maybe it's because, of all of these government programs and stuff. Well, I think that has added to it a little bit. I mean, that has helped a little bit, but I think part of it also depends on demographics, right? Where you are, and I think, what your market is. Ours happens to be working class in these areas like Texas and Arizona, and for some reason, these people seem to be doing okay and paying their rents. Talk about, if you would, just the differences that come to mind when you think about, why there would be distress in mortgages across the country as a whole, but not necessarily with rent payers. Why would that be?
I think I will agree. When this first started, a lot of people were concerned that the amount of families defaulting on their mortgage or unable to pay their rent would be 30% plus. And that hasn't yet happened overall. So it has been less. I think it's been less than everyone expected. But that doesn't mean that maybe it's because of stimulus or other types of programs. But at some point, if a family does lose a job or an income, that does make it's going to create challenges. And I don't think it's tough to differentiate between homeowners and renters. But I think there's a lot of struggles out there that, maybe they haven't come to the forefront yet, but they will.
Yeah. What about the demographic issue? Are you seeing in mortgages, specifically either, the types of homes or across the country in different areas, like varying levels of distress?
I think it's just there's more of a concentration in low to moderate income neighborhoods. Those are ones where I think there's less of a financial safety net, number one. And number two, there's just probably been more job losses that have affected those of more modest means.
Yeah. And what about on the upper end of stuff, George? I'll tell you the reason I'm thinking about this is, I live in Montecito, which is, the 93108 zip code is probably one of the wealthiest zip codes in the country. And, the single family market here is on expire, right? I mean, it is, probably going, literally houses are selling for probably 20% more than they were listed for in pre-COVID. And we're talking about multi-million-dollar acquisitions. And to me, that has a lot to do with people wanting to move out of, LA or San Francisco into, this nice little beach community that's, not, affluent. But it's also because you've got significantly, they're, for people who are doing mortgages, a lot of them are ultra wealthy. They're not using mortgages anyway, but it's pretty attractive rates too right now, right? I mean, it's so you've got that balance. Are you seeing? What are you seeing, if anything? I mean, usually you're not dealing with the higher end homes, but you are in pre-REO. So what are you seeing on that side?
Everything you just described is accurate, and I'd say it's high end and low end. The low mortgage interest rates are making it very attractive for families of all sizes. Plus, the fact that more people are working from home and spending more time at home. Our REOs, which many of them are concentrated in low to moderate income neighborhoods, these are selling very fast today at prices that were significantly more, same 10-20% better than they were pre-COVID, and that's extraordinary, and something we would never have anticipated when COVID first hit, that it was going to be helpful for the housing market. But I think if you look forward to the future, it's tough to say how long this can last. I mean, at some point, all these millions of families that are on some kind of payment arrangement or forbearance, that runs out, their economic situation hasn't improved, and they end up getting foreclosed upon. That will increase the inventory significantly, probably at all income levels, but again, concentrated on the lower income levels. That should probably increase supply, should push prices down. But the low mortgage interest rates, this economy is so weak that the low interest rates there's nothing, they can't raise them for the next probably several years, 2 to 3 years at a minimum. At least, and that will make it so attractive to buy. So that will keep the housing market propped up.
But then there is definitely a geographic element of that too. Because, I just look at what's happening. For example, you've been in my house in the northern suburbs of Chicago. Again, really nice neighborhood, really affluent place. And then the prices there, I mean, I'm looking at my house there. I'm trying to sell, and it's now listed for a full 20% less than I bought it for in 2012. Oh. And so, what's driving the differences in terms of, and it might just be because of all the mess that Chicago's in, and I know that from your from your own personal
walking into work.
Yeah. So what do you make of that? I mean, what are you seeing across the board, across the country in different markets? Because I know you guys are kind of all over.
Yeah, we do see that. I mean, what's interesting, and you mentioned this earlier, is that in the cities, there's definitely people that think, and probably rightly so, they moved into the cities to be close to work. Now they can suddenly work from home in many cases. Then why not move to a neighborhood that they really want to live in? That's maybe a smaller community, a resort community. In some of those areas, hey, we can live and work here if we're doing work from home. So I think there's definitely going to be a continued exodus from the big cities. And that will, that's not new. That's a lot of people expect that. And, that will reduce probably have a reduction in time of values in cities and, New York, Chicago, these downtowns, and probably increase values as you go to the suburbs. I mean, I live in Barrington, which has been another affluent suburb of Chicago, but it has this, for the last several years with all the job losses, has been a very weak market. And, but in the last 6-8 weeks, we've seen properties that were on the market for a year or two. They're all selling, getting, under contract signs, sold signs. And that's the big change. I think it's going to be a great time to sell your property. If ever there was a time to sell it, this is the market's strong.
You would think, but I'm really struggling with this thing, unfortunately. But I may end up just keeping it for that reason, because I think it's there's something going on in the Chicago suburbs in particular. But what do you anticipate? So you talked about sort of how we might be sort of at 2012 levels and sort of going back in time from there. What is it that from the that you're seeing that makes you think we're going to continue down this path? And at some point, does it just, does the full kimono come off, and all of a sudden you see the sort of the pinnacle of the drop in the single family market?
Yeah, it's we're still. We had a long run up of since the last since the 2008 and the Great Recession. There was a long run up that included increases or appreciation in home values for almost a decade or more than a decade almost, and that is. I think right now we're on kind of the fumes of that. I mean, there's different circumstances that are extending it, but at some point there has to be a big, there will be a massive spike in foreclosures. I mean, it's inevitable, and that increased supply should drive down prices, even with the low interest rates.
Do you see,
when that happens, it's hard to say.
Do you see that? Okay, say for example, a COVID vaccination becomes available in December, becomes widely disseminated by March, April, May. All of a sudden, business as usual. Do you see that could put the brakes on this, or do you feel like, that train has already left?
I think it's the latter. I think that's. I don't think the vaccine will be a cure-all for the challenges we have in the country. I mean, we were due for a downturn,
sure.
And COVID happened to be the trigger. It could have been any other reason, but COVID happened to be the trigger. And I think we're still seeing some activity. But if you look back at 2008, when things started going awry, in 2009, the government put in place some kind of credit. I think it was about a $7,500 credit to incent buyers to buy a home. And that helped kind of prop the market up for a little while longer, maybe a year. And then it was already weak and weakening, but I think it probably slowed the contraction. Here, we're due. I mean, if you go back in history, we're due for a downturn, and the economy is definitely on the decline. The housing market is still staying strong, and actually, in some cases, like we pointed out, is improving. But that the economic fundamentals behind it are not there, so there needs to be a correction.
Here's the problem, and I'm playing devil's advocate here because I hear you, and in many ways, I was sort of being this drum of tsunami, of defaults and all that. But what's going on with the Fed and the interest rates and then fiscal policy, it just seems to me like as long as the Fed keeps printing money, asset prices keep staying high as they are. It's hard to imagine if something positive comes out of the vaccine, that there isn't some artificial continued elevation of those asset prices. I mean, look at the stock market, right? I mean, and all these markets are ultimately correlated. Right?
Mm-hmm.
We're doing things differently than we did in 2008. So I just wonder how, if there is a possibility where there really is a truly, sort of soft landing because of the extraordinary means that the Federal Reserve and fiscal policy have taken. But you don't see that, I guess. I mean, I think you're probably, you're kind of where I was before, but now I'm just looking at it saying, I mean, listen, and we had one little dip in the markets at all-time highs, and so I'm not really seeing, exactly what happens, across the board if everything is correlated. But I don't know, your thoughts on that?
I will say it's tough. The good news, I think, for any investor out there is that the market is unpredictable and people can make convincing arguments on all sides, and that creates opportunity. I mean, the problem was a year ago, we had so much data that informed us that, hey, this is what happens with distressed mortgages or real estate. When the markets become predictable, that's when returns contract. Now the market is unpredictable. I would think you could have some of the brightest minds in the country, put them all in a room saying what's going to happen the next year in this country to the economy. You'll get multiple different answers. You go back a year or two and you'd probably get you come to some kind of consensus. By and large, you wouldn't get that today. And I think that unpredictability creates opportunity. I mean, unfortunately, the opportunity is going to be the result of I think to the extent opportunity comes, it's due to some significant economic challenges rippling through the country and the globe for that matter.
What we do know, though, is right now, as you mentioned, your business, HP Servicing, is seeing an increase on opportunity and inventory. Talk a little bit about what HP Servicing does. Remind us kind of like the way this whole notes process works and what non-performing notes are and all that stuff.
Sure. So HP buys mortgages when people can't pay. And so typically a bank or hedge fund will own a loan. And then when they stop paying, they'll be willing to sell that at a discount. And the further behind they get, generally the greater the discount. And so we buy those loans. We crowdfund the money at HP Servicing. And we use that money for two things. One is to buy those mortgages at discounts and then work them out, ideally. And then the other is to... what we've used it for is to build a national mortgage servicer. And just to give a little detail on that, we've been buying mortgages for a decade. In that decade, we went through 9 different servicers. We were never satisfied with one of them. So in 2017, or with one of them, with any of them. And so in 2017, we decided to start our own servicer and thinking that it would take us maybe a year to build it out. Here we are 3 years later. We are licensed in every state of the union except for New York. And New York is imminent. They announce their new licensees every Friday. We're eagerly anticipating an announcement today. They publish on their website, so hopefully we'll be there. We've completed everything they've asked us for, and we're thinking about the altar on that. But either way, right now we're a national mortgage servicer, and so we service our mortgages, plus we have about 40 additional clients, which we service for, and we're continually adding new clients. The fact with the distress and the new loans, new pools of loans being sold into the market, new pools of defaulted mortgages being sold in the market, there's definitely, we're seeing more and more servicers or more of a demand for a servicer who can meet the needs of those investors who hold non-performing mortgages. So we're definitely seeing an uptick in business.
And then there's a fund. Tell us about the fund.
Yeah, so the fund is the we crowdfund this money to buy both the loans and fund the servicer, and that has we pay the first 10% to investors, and it's typically distributed monthly, and that's the fund that we operate now. It's started in November of 2018. It closes November 5th of 2020, so that'll be the last time that it's available. We are working on another fund to go after that. The next fund right now, we're anticipating that it will distribute 7% as opposed to the 10%. And that's partially a response to the extremely low interest rate environment that we are in today, which compared to 2018, it's continued to drop. So we think 7% will be well received.
Oh, wow. Okay. And so the 10% opportunity is about to end. How long do you think, or how much you got left in that one?
There's ample capacity. We have November 5th is the date, but there's room for more investors. Remember, we started this fund in November of 2018. In May of 2019, we stopped accepting new investments, and that went on until, I believe, November of 2019. For several months, we wouldn't have taken money. The reason is we had raised a lot of money, and we just, as we mentioned before, there just weren't the opportunities to deploy it. Now, fast forward to 2020, post-COVID, we're seeing lots of opportunities. So now we do have capacity, so we are welcoming new investments in.
And I'm just going to back up for a second and remind people kind of the business model of a non-performing note. Essentially, you've got somebody who's not, you're not paying their mortgage, and the bank, may end up. These could be, bank-held notes, or they could be from seller financing, whatever. And then somebody ends up, whoever owns that ends up selling that debt to an investor like you or me or George's fund. And then at that point, you've presumably bought these things at a big discount. And so you have a few different options. At that point, you could technically just foreclose on somebody, take the property and sell it. The other thing is you could pay him some money and tell him to scram and see if that works. Or you could try to negotiate some kind of a new mortgage that somebody can afford and wipe out, most of their old debt and try to keep it performing. Now, the third option is what George's company really tries to do. And so there's a social element of doing good behind the fund. Is that about a pretty good summary?
That's a great summary, Buck.
Good. You can use that.
Yeah, I was going to say, we might have you write a commercial or two.
And so effectively, that's important because I know there's, especially these days, there's a strong push, I know, by a number of investors to have some sort of social meaning behind their investments. Well, this one does. In addition to that, I do want to point out that, this is not an easy business to do as an individual. I have tried doing it myself, and I can tell you that I lost a lot of interest pretty quickly just doing it myself because it just seemed tough. And I think what makes this business kind of a lot more stable is the fact that these, first of all, George's company, this is all they do. He's very, very good at this stuff, and they deal in large numbers. So in general, my personal feeling on note investing is if you're going to do it, I would highly recommend doing it through a big fund rather than doing it yourself. And I just from speaking from personal experience. George, do you think that's fair in terms of the talk about the advantage of doing this through large numbers? Because I think that's critically important.
Yeah, I think you're right. We don't make money on every loan that we buy. There's oftentimes situations where you rely on an agent driving by saying, hey, I think that property's worth $100,000, and then you get it back and foreclose. Now you go inside and it's, termite infested or something like that. So we've, if you buy 100 loans, there's probably a portion of them, it could be 10% of them where you're not going to do well. So the problem, I think, for individual investors is if you happen to buy, one or two or three, and they all happen to be in that, challenging bunch where you could lose money, and that increases the likelihood that you'll have some investors who didn't do well. Maybe they'll win on one, lose on the other, and they said, hey, this didn't work. So the larger the pools or the larger amount of loans you buy, generally the better that you'll do in aggregate. And I think that's what's proved out at HP.
The other part of this fund that I think is really unique and something that I think is important to know is that unlike most funds, unlike most placements, I should point out this is also open to anybody. You don't have to be accredited, and investments can be as little as $100. So it really is open to anybody. But there's also an element of liquidity to this, which is really unusual for a fund. Do you want to talk a little bit about that, George? Because I think that also helps people to make some decisions.
Sure. So I'll reiterate the first 2 points. One is, minimum investment is only $100, and we are open to accredited and non-accredited investors. So like you said, almost anyone can invest. And we do offer best efforts liquidity, which basically means that although the investment is for a term of 5 years, you can request your money back at any time, and we'll undertake our best efforts to return the money to you. Now, when there is a caveat to that, though. We pay, as I've stated before, the first 10% to investors. But if you redeem in the first year, that goes from 10 to 8. In the second year, it goes from 10 to 9. After 2 years, you get to keep the full 10%. And the next caveat is typically we will, once the redemption is requested, we return that money within 30 days. We were able to do that for years up until COVID. COVID hit, we had a huge number of redemption requests, unprecedented number, and we're still working through those requests. So I guess you want to hear that, yes, we do process redemptions, and we continue to process redemptions. But once an investor, and it's typically done within 30 days, except in extreme circumstances like COVID, things can get delayed, and they are. But we're distributing we have distributed considerable amounts of money since COVID has began.
So just as a reminder, the deadline for the 10% fund is November 15th, meaning that if you want to get in there and get a 10% return, that's what you need to do. How do you invest, George? You want to ask?
Sure. You go to ahpservicing.com. There's a button near the top. Invest now. You can click and you walk through a very expedited process where in a handful of minutes you can complete the investment process, sign the investment agreement, even request an ACH to fund your account, all within a few minutes, all online.
George Newberry, everyone. Always a pleasure, George. Thanks for joining us.
Likewise, Buck.
Be right
Thanks
back.
for having me on again.
Welcome back to the show, everyone. Hopefully you enjoyed that. Lots to look forward to. Lots of excitement. You can't go outside. You can't really go to sporting events, but you can watch what is going to turn out to be one of the, if not the craziest presidential elections of all time. Who knows what's going to happen? I mean, everything's so unparalleled. I have some theories on what I believe that happened that I'm not even going to say out loud because they'll be so controversial. But it'll be interesting. It's like a reality TV situation. And I guess, we do have a president who had a reality TV show, so maybe that makes sense. At any rate, this is a good time to be very tuned in. Don't be scared. Look at the reality. Is it a time that you should just be sitting on the sidelines and not buying? I don't know about that. It could be. Could you be buying and sitting on the sidelines and waiting for better times because you bought when everybody was scared? In certain areas, I believe that may be the case. I mean, I think that still may be the case for apartment buildings. So anyway, we'll see what happens. If you're not part of Investor Club and you are an accredited investor, make sure you sign up at wealthformula.com because you're going to get a front row look at the different things that we have coming up in the next 3 months. It's going to be very exciting. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.
Thank you for listening to the Wealth Formula Podcast. Visit us on the web at wealthformula.com. The information contained in this podcast are opinions, not fact. As always, consult your own financial team before making any investment. See you next time.